Greetings everybody, in this video we're going to talk about sources of income. Let's hit it. All right, everybody, in this video, we're going to talk about the distinctions between various sources of income, including income from services and property. Awesome. All right. Types of income, you can have, could have earned income, which is like from services. Very good example. I go to George Mason. I teach at a tax class. They pay me a salary. That's earned income. Okay. Generated by my efforts. And believe me, there's a lot of work that goes into these things. For example, I'm shooting this video in November, just after Thanksgiving, where most people are still on the couch regretting the fact that tomorrow is Monday. I'm here doing this. So, there's definitely a lot of efforts that's going into this. Income from property, which is going to be your unearned income. That's going to be, gains of sales from loss of property. Gains and losses from sale of property, dividends, interest, royalties, and annuities. Could also be pensions. So if you have an IRA pension that you're drawing upon because you're retired, if you have a pension because you're retired from the military or you're retired from a company that still offers defined benefit plans, that's all unearned income. It does depend on the type of income and the type of transaction generating the income. Can sometimes flop something from earned to unearned. Very rarely though. Usually after a while you just get a sense of these things, and is that earned income or unearned income? Oh, that's earned income. And then maybe you think about it a little. Maybe it isn't. Yeah, actually, I think it is. Yeah, it is. It is. And then you go look up the reason, and you're like, okay, here's why. Okay, what's an annuity? Depends on what type of annuity you're talking about. It could be a fixed income annuity. It could be a variable rate annuity. But it pays a stream of equal payments over time. Now, if you're talking about fixed income annuities, they will be equal over time. Variable rate annuities, maybe not as much. And variable rate annuities are actually investable securities, whereas fixed rate annuities are usually seen as life insurance products. For those of you going into wealth management, you need to know that. For the other guys, it's kind of nice to know. So a portion of each annuity payment is going to be non-taxable return of capital, and the remainder is going to be gross income. Okay, but if I have a variable rate annuity that's invested in the stock market, that should be capital gains, right? No, that's going to be ordinary income. Because what's happening is that that investment that's happening is happening within a protected sort of trust instrument, for lack of a better term. And so when it gets pulled out, it will be gross income minus whatever got paid into for it. Okay. Taxpayer uses the annuity exclusion ratio to determine. So basically what will happen is they say original investment, expected value of the annuity. That's your exclusion ratio. The way this actually gets operationalized, if you take a look at, you see my 1099R video, I talk about box 5. That's usually where this is going to get reported. Well, first of all, they're going to report on 1099R. So you're going to have gross proceeds. You're going to have taxable proceeds. And what the difference is, if you go to box 5 and you subtract if you take box 5 and subtract it from box 1, that gets you to box 2, which is going to be your taxable income. Again, if you haven't watched that video, I'd recommend looking at it just to kind of, like I said, guys, I've said this in other videos and I'm going to say it again. The stories that I bring to this are here to enhance the experience. But more important than that, the videos that I've done, the concept videos where we talk about, tax forms and things of that nature, take this and bring this to life. So it's very important that we do this, and you want to make sure that we're taking care of that, okay? With your annual exclusion ratio, again, that's going to be used to determine what is taxable and what isn't. For annuities with a fixed term, the expected value and the number of payments will generally be fixed. Okay, in January, Graham purchased an annuity for $99,000. The annuity pays her $10,000 a year for the next 15 years. How much of this in the $10,000 should be included in her gross income? Answer is $34,000 because the exclusion ratio is 99 over $150,000 is 66%. Now, how that gets done, and again, they're saying how much gets into the gross income. What they're referring to is gross income for taxation. You're going to report both the gross, which is the $10,000 per, the $10,000. They're saying $10,000 per year. So the $10,000 per year will be reported at gross. The $3,400 will be the taxable amount in box 2 that will actually be taxed on the form. But you will report both. It's a little misleading there. But when we're kind of talking about this, what they're talking about is how much is going to be reported in her gross income for taxation. Okay. And look, I'm not trying to throw these terms out there to confuse you. But everybody who's in this class is going to be an accountant at some time. Now, whether you go into tax accounting, if you want to go into tax accounting, feel free to reach out to me. I'm happy to talk you into moving to the dark side with me. You need to know that, hey, look, this stuff does go on the tax return, but maybe it gets, it's done for different reasons. All right. For annuities over life, they must use tax tables to determine expected life value. And by the way, unless you go work in an office that deals with calculation of this, you're probably never going to have to calculate this on your own. Okay. Unless the person doesn't do the calculation correctly. And then you want to say, okay, this is how much they paid, blah, blah, so on and so forth. And again, if you beat the average, that's good on you because, the bad news about it is that if you beat the average with a expected life value, all that income that comes in after you hit your expected termination date, I know that sounds kind of wonky, will be 100% taxable income because all of your principal will have already been eaten up. Property dispositions, that's going to happen with gains or losses. Again, very good common example of this is selling a stock. I bought the stock for $10, I sell it for $15, I got a $5,000 gain, or $5 gain. Yeah, I bought it for, let me say that again. Bought it for $15, sold it for $20, $5 gain. And that gets reported. If I held it for more than a year, long-term capital gain. If I held it for a year or less, short-term capital gain at ordinary rates. Okay. And in fact, that's how you should practice this. You should say long-term, again, when we're talking about individuals, you say long-term capital gain at preferred rates, short-term at the ordinary rates. Okay. Easy peasy lemon squeezy, as my son used to say when he was very small. Other sources of gross income from other than wages of business or property, income from flow-through entities. So, for example, maybe I'm a partner at a partnership. Maybe I have my own business. Well, actually, not maybe. I do have my own business. And when this entity makes money, it passes that income to me, and then we move forward with that. If the entity is a flow-through entity, such as a partnership or an S corporation, the income and deductions of the entity flow through to me, and that's where everything goes good. Okay. Alimony for taxes purposes, it is defined as a transfer of cash made with a written separation agreement or a divorce decree. All right. The most important thing you need to know about alimony, if the divorce took place on January 1st, 2019 or later, the transfer of money has no tax effect. There's no tax deduction. There's no tax pickup on the other side. If the divorce decree happened before that, then there is a tax pickup and a taxable amount. Okay. Payments that do not qualify, a property division. So if you're going through a divorce and they say, look, the only major asset you have is the house, we're going to temporarily allow the spouse to live into it until, 5 years later, she's going to have to sell it and then move someplace else. Proceeds split 50-50 between the two of them. Okay, that would not be considered a taxable event. I mean, well, if there's any gains, obviously there would be. But the fact that they transferred her use of the house for the next 5 years, that in and of itself would not be a taxable event. Child support payments, as long as it is defined as child support payments in the divorce agreement, they're not taxable. Why? I don't get tax deduction for supporting my kids. For the divorce, and we already talked about the dates, so I'm not going to worry about that. Prize awards and gambling winnings. There are specific exclusions. So, for example, scientific literacy or charitable achievement under certain conditions. Nobel Peace Prize is probably the biggest example I can think of there. So if I get a Nobel Prize for, say as an economic theorist, I come up with a new form of economics and it's recognized and they say, bravo, Kevin, really smart, blah, 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 so on and so forth. Here's a Nobel Prize for economics. And by the way, and attached to that is, I think they still do $250,000. Okay. By the way, with most people, the $250,000 is nothing compared to what they're going to get as a result of getting the prize. Usually they'll be, if they're not tenured at a university at that point, they can be tenured. They'll do pretty well for themselves. Okay. Employee length of service, if it's $400 or less for tangible personal property. So for example, if I've got an employee out here and he, he's been here, we'll say he's been here for 10 years, and I'm going to go get him a plaque and say, thank you very much for being here for 10 years. Here's your plaque. Congratulations, blah, 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 so on and so forth. And I spend $150 on the plaque. That $150 does not have to be included in his income. Now, if I go out and I buy a $1,000 sword and say, this is, the sword of Beta, the Beta sword, and I give it to him and it's $1,000, I do have to include that as part of his compensation. Team athletes from the U.S. Olympic Committee, again, there's AGI limits. I think probably the best example for this, when Michael Phelps was really big into swimming, and I think he got like 8 gold medals in 1 year. His 8 gold medals would not be exempt under this rule because he makes a boatload of money off of endorsements. Every time I go buy my swimwear, there's a Michael Phelps something out there. Or at least there used to be. Not as much as there used to be. Okay. He was killing it in the endorsement ring. Unlike most swimmers. This really applies, like somebody who's, look, I've got my one event that I'm good at. I go out there, I do my thing. They give me a gold medal, pay me $25,000 on top. It's good. Okay. Social Security benefits, 85% of Social Security is taxable to the employee, to the recipient, if they are above certain AGI thresholds. Modified AGI is regular AGI, excluding 50% of Social Security benefits, plus tax-exempt interest income, excluded foreign income, and other certain deductions. There's actually 3 gates to this. There's one where it's basically all of it's tax-exempt. There's one gate where it's 50% of it's taxable, and then there's another gate that's 85% taxable. I think probably the biggest thing that most people get hung up on there, they see 85% and they assume that it's 85% tax. No. That's 85% taxable income. If they are at a 22% marginal rate, and we'll say an effective rate of 17%, they got $10,000, they're paying $1,700 in taxes. Okay? That's going to be what it is. Depending on how we calculate the income and all that sort of stuff. Okay? So, it's not 85% of it is the tax. It's others. Okay, so so they're talking about if single taxpayer, again, these are the gates that they're kind of talking about. I generally don't test that too much, and if I do, I'm going to warn you about it ahead of time, just because of the fact that these numbers change, or at least, actually, these numbers haven't changed in a while, but normally numbers in the tax world change a lot. So we don't normally make people memorize, AGI thresholds and things of that nature, just because be a little unfair, because, we're going to make you memorize a number once that you're probably not going to use ever again, because by the time you get to the tax preparation world, you're not going to use it. Okay. We try to get you to the concept. Okay. Imputed income, certain employee discounts or loan guarantees, income via indirect benefits. So, all right, now before you have a heart attack and say, wait a minute, I work at Starbucks and I'm worried that the free coffee they give me, now I've not been paying taxes on that. That's not what they're talking about here. They're talking about here where it is just significant. So, for example, I work at a Mercedes dealership. The car that I want to buy is $70,000. They give it to me for $20,000. They sell it to me for $20,000. I'm exaggerating this. They would never do that, I'm sure. But I'm trying to exaggerate to make a point. $70,000 car down to $20,000. There's going to be some imputed income on that one. Okay. Okay. Now, the other thing, low interest loan generates... and actually, you don't see this as much from, employees. Well, I guess you do a little bit. Where we tend to see this the most is business relationships. So, for example, I've been banking at Bank X for a number of years. I know the president personally, good friend of mine. Blah blah blah. We golf together. Our kids are at the same swim club together all the time. And I decided I'm going to go buy one of my houses here for, $3 million. And he says, Kevin, come to my bank. I'll get you a really good deal. Market rate's at 6% interest. He gets it to me for 1%. There's going to be an imputed thing that's going to have to happen here. Okay. Now, the problem you're going to run into as a taxpayer, catching that's kind of difficult. As the CPA preparer. And usually the way you're going to catch it is the client's going to be sitting in your conference room here and bragging about how you got this sweet deal on this. It's like, really? Oh boy, you may have an income issue. Okay, we'll have to look that up. Okay. And then, hopefully you don't say this around him to where he says, okay, I don't want to tell him I'm not going to tell Kevin any of my good deals going forward, because I know he'll threaten to tax me on it. But just as it's hard for us to figure it out, sometimes it's hard for the IRS to figure it out too. Borrow is deemed to pay imputed interest expense to the borrower, interest income to the lender, and then the lender is deemed to have returned the imputed interest amount between the borrower and the lender. Imputed interest rules do not apply to loans below $10,000. So if I go out and I just borrow... and actually where you tend to see this the most, it's not so much that the interest will be low. The interest will be non-existent. Okay, so I go and I borrow money to go buy my house, and because I'm a friend, he says, nah, because you give us so much business, we're just going to cover your interest for you. Now you're going to have an imputed interest issue. Discharge of indebtedness, this will be our last topic for this. But basically, what they're talking about here is where you are, most common that we tend to see in this office, clients run up a credit card and business failed, something went wrong. They call up the credit card company. I can't pay this. They said, okay, fine. We're going to discharge this for you, and then we'll never have you as a client ever again. However, what they don't tell you is that later on that year, they're going to file a 1099-C with the IRS, and then you're going to have to pay taxes on that discharge of credit card income. It's a bad day. Okay? It's a bad day in that sense. All right, folks, so that's it for this video. I want to say thank you very much for watching this video, and I look forward to seeing you guys in class.